Most Americans believe the financial system is stable. They believe banks are safe. They believe the Federal Reserve has everything under control. But what if the biggest risk right now isn't a stock market crash, isn't inflation, and isn't even a recession? What if the real danger is something much quieter, something happening behind closed doors, inside the banking system itself? Because right now, U.S. banks are behaving very differently than they did just a few years ago. And whenever banks change their behavior quietly, it's usually because stress is already inside the system. Today, we're going to break down what's really happening, why it matters more than most people realize, and what this could mean in the months ahead. Stay with me, because by the end of this video, you'll understand why the system feels calm on the surface but unstable underneath. Cat 1, the warning signs no one's talking about. The silence is deafening. Let me start with something strange. When was the last time you heard a major news outlet talk about banking stress? Not a soundbite, not a passing mention, but a real deep dive into what's happening inside America's banks? Exactly. Silence. And that silence? That should worry you, because the most dangerous financial crises don't announce themselves with sirens and flashing lights. They build slowly in the shadows until one day the pressure becomes too much. The data. They're not showing you. Here's what most people don't know. Since March 2023, something fundamental changed in the American banking system. And I'm not just talking about the collapse of Silicon Valley Bank or Signature Bank or First Republic. Those were symptoms. I'm talking about the underlying disease. Right now, if you look at the Federal Reserve's own data, U.S. banks are sitting on over $500 billion in unrealized losses. Let me say that again. Over $500 billion in losses that haven't been recognized yet. They're just sitting there, buried in bank balance sheets, hidden in plain sight. How is this possible? It comes down to something called held-to-maturity securities. During the pandemic, when interest rates were near zero, banks loaded up on long-term bonds, safe bonds, treasury bonds, mortgage-backed securities, the kind of assets regulators love. But here's the problem. When the Federal Reserve raised interest rates faster than at any point in 4 decades, the value of those bonds collapsed. If you bought a 10-year treasury bond yielding 1.5% in 2021, and now new bonds are yielding 4.5%, your old bond is worth significantly less. It's basic math. Banks don't have to report these losses immediately if they claim they are holding the bonds until maturity. That's the loophole. But here's the terrifying part. What happens if depositors start pulling their money out? What happens if banks actually need to sell those bonds? And those paper losses become real losses. And that's when the cracks start to show. The depositor problem. And this brings us to the second warning sign, deposit flight. Since early 2022, U.S. banks have lost trillions in deposits. Not millions. Trillions. Where did that money go? Some went into money market funds, which suddenly started offering 5% yields. Some went into treasury bills. Some went into the stock market. But here's what matters. When deposits leave banks, banks lose their cheapest source of funding. And when they need money, they have to borrow it at much higher rates. Or worse, they have to start selling those underwater bonds we just talked about. This creates a vicious cycle. Deposits leave, which creates liquidity stress, which forces asset sales, which crystallizes losses, which spooks more depositors, which causes more deposits to leave. Does this sound familiar? It should, because this is exactly what happened to Silicon Valley Bank, the regional bank time bomb. Now here's where it gets really interesting. The big banks, the JP Morgans, the Bank of Americas, they're mostly fine. They have diversified deposit bases. They have access to emergency funding. They're too big to fail, and everyone knows it. But regional banks, mid-sized banks, they're a different story. There are over 4,000 banks in America, most of them you've never heard of. And many of them are facing the exact same pressures that took down SVB, unrealized losses, deposit outflows, rising funding costs, concentrated risk. The Federal Reserve knows this. In fact, they created an emergency lending facility specifically to help these banks after the March 2023 crisis. It's called the Bank Term Funding Program. And at its peak, banks borrowed over $160 billion from this facility. Think about that. Banks needed $160 billion in emergency loans just to stay afloat. And this was after the Fed and Treasury Department stepped in with guarantees and backstops. The BTFP was scheduled to expire in March 2024, and while usage has declined, the fact that it existed at all tells you everything you need to know about the hidden stress in the system. Act 2. The 3 forces creating perfect storm conditions. Force. Number 1. The interest rate trap. Let's talk about the trap the Federal Reserve has created. And yes, I'm calling it a trap because that's exactly what it is. For over a decade, from 2008 to 2022, we lived in a world of artificially low interest rates, 0%, sometimes negative in real terms. The Fed kept rates low to stimulate the economy after the financial crisis, and then they kept them low through the pandemic. This encouraged everyone, individuals, corporations, and yes, banks, to load up on debt. Cheap debt. Because why wouldn't you? Money was practically free. But then inflation hit, and the Fed had no choice but to raise rates, fast, from 0% to over 5% in less than 18 months. The fastest hiking cycle in modern history. Now here's the trap. The Fed needs to keep rates high to control inflation. But high rates are absolutely crushing for a banking system that was built for a zero-rate world. Every month, rates stay elevated, the pressure builds, the unrealized losses grow, the funding costs increase, the stress intensifies. And here's the kicker. The Fed can't just cut rates back to zero, even if they wanted to. Because if they do, inflation roars back. They're stuck. And so are the banks. Force number 2. Commercial real estate is quietly imploding. Now let's talk about something that's not getting nearly enough attention. Commercial real estate. Think about what happened over the past few years. During the pandemic, millions of Americans started working from home. Companies realized they didn't need massive office spaces. Businesses closed. Retail suffered. And suddenly, all those commercial buildings, the office towers, the shopping centers, the hotels, they're worth a fraction of what they were in 2019. But here's the problem. Those buildings were bought with loans. Loans from banks. Specifically, from regional banks. Commercial real estate loans make up a huge portion of many regional banks' loan portfolios. We're talking 30%, 40%, sometimes more. And right now, those loans are in serious trouble. Property values are down 20%, 30%, 40% in some markets. But the loans are still on the books at full value. And when those loans come due and need to be refinanced, property owners are discovering they can't get new financing. Or if they can, it's at much higher interest rates that the property can't support. So what happens? Defaults, foreclosures, losses. And who takes those losses? The banks. The data is starting to show this. Delinquencies on commercial real estate loans are rising, not slowly, rapidly, and we're still in the early innings of this crisis. Some analysts estimate that commercial real estate values need to fall another 20% to 40% before we reach a bottom. And every percentage point those values fall, that's another hit to bank balance sheets. Force number 3, the shadow banking system. Now here's the part that should really keep you up at night. Because the regulated banking system, the one with FDIC insurance and Federal Reserve oversight, that's not the only game in town anymore. Over the past 15 years, a massive shadow banking system has emerged. Private credit funds, non-bank lenders, fintech companies, cryptocurrency platforms. These entities do many of the same things banks do. They take deposits, they make loans, they create credit, but they don't have the same regulations, the same oversight, or the same safety nets. And this shadow banking system is huge. We're talking tens of trillions of dollars. Here's the problem. When stress hits the traditional banking system, it doesn't stay contained. It spreads. It leaks into the shadow banking system through 1,000 different connections. Counterparty relationships, funding markets, derivatives, collateral chains. Remember 2008? The crisis didn't start in the commercial banks. It started in the shadow banking system with Bear Stearns and Lehman Brothers, and then it spread everywhere. Right now, we're seeing warning signs in the shadow banking system again. Private credit funds are starting to see redemptions. Some crypto lending platforms have already collapsed. Non-bank mortgage lenders are pulling back. The connections between the traditional banking system and the shadow banking system are complex, opaque, and deeply intertwined, which means when one gets stressed, both get stressed. And regulators, they have far less visibility and far less control over the shadow banking system, which means when things go wrong there, they go wrong fast and in ways that are hard to predict or contain. Act 3, why the official story doesn't add up. The narrative versus the reality. Now, let's talk about what you're being told versus what's actually happening. The official narrative goes something like this. Yes, there was some stress in the banking system in March 2023, but the authorities acted quickly, the contagion was contained, the banks are well capitalized, and everything is under control now. The system is sound, nothing to worry about. Move along. But if everything is so sound, why are banks still losing deposits? Why are unrealized losses still massive? Why do we keep seeing quiet bailouts and emergency measures? Let me give you some examples of the disconnect. First, bank stock prices. If the banking system were truly healthy, you'd expect bank stocks to be doing well, right? But look at the regional bank index. It's still down significantly from pre-crisis levels. The market is telling you something. It's saying, we don't believe these banks are as healthy as they claim. Second, lending standards. Banks are tightening lending standards at the fastest pace since the 2008 financial crisis. They're making it harder to get loans, harder to get mortgages, harder to get business credit. Why? Because they're trying to conserve capital. They're trying to reduce risk. They're acting like banks in crisis, not banks in recovery. Third, and this is really important, the Federal Reserve's balance sheet. After the March 2023 crisis, the Fed's balance sheet actually expanded again. After years of quantitative tightening, trying to shrink it, suddenly they had to inject hundreds of billions back into the system. That's not what you do when everything is fine. Now, let's talk about something that doesn't get discussed enough. The accounting tricks that make banks look healthier than they are. Remember those held-to-maturity securities we discussed? That's just one example, but there are others. Banks can use something called regulatory capital relief to make their balance sheets look stronger. They can move assets off balance sheet into special vehicles. They can use derivatives to hedge risks without having to report the full exposure. They can delay recognizing loan losses by extending and pretending, giving troubled borrowers more time, more forbearance, kicking the can down the road. All of this is legal. But it creates a distorted picture. It makes banks appear more stable than they really are. And it means that when the truth finally comes out, it comes out suddenly and violently. This is what happened in 2008. For months, banks insisted everything was fine, right up until it wasn't. Right up until Lehman Brothers collapsed on a random Monday in September and nearly took the entire global financial system with it. The regulatory blind spots. And then there are the regulatory blind spots, the things regulators either don't see or don't want to see. After 2008, we were promised that regulators would be more vigilant, that stress tests would be rigorous, that banks would be forced to hold more capital and more liquidity, that we'd never be caught off guard again. But what happened with Silicon Valley Bank? It wasn't some complex, hard-to-understand risk. It was basic interest rate risk, duration mismatch, banking 101, and yet regulators missed it or ignored it until it was too late. Why? Part of it is regulatory capture. The people who regulate banks often come from banks or go to work for banks after they leave government. There's a revolving door. That creates conflicts of interest. Part of it is political pressure. Nobody wants to be the regulator who sounds the alarm when the economy seems to be doing okay. Nobody wants to be blamed for causing a crisis by talking about the risks. And part of it is just the sheer complexity of the modern financial system. It's so big, so interconnected, so global, that even the smartest regulators can't fully understand all the risks. But whatever the reason, the result is the same. The official story about the health of the banking system is based on incomplete information, conflicting incentives, and wishful thinking. AC4. What happens next and what it means for you. 25 and 32 now. The three scenarios. So what happens next? Let me lay out three scenarios from best case to worst case. Scenario 1, the soft landing. This is the scenario the Federal Reserve is hoping for. Inflation continues to fall. The Fed is able to cut interest rates gradually. Banks slowly work through their unrealized losses. The commercial real estate market finds a bottom. Deposits stabilize, and we avoid a major crisis. Is this possible? Yes. Is it likely? That's debatable. Because it requires almost everything to go right. It requires no new shocks to the system, no geopolitical crisis, no unexpected recession, no major bank failures, threading the needle perfectly. Scenario 2, the slow bleed. This is actually the most likely scenario in my view. We don't get a dramatic 2008-style collapse, but we also don't get a clean resolution. Instead, we get a prolonged period of stress. More bank failures, but smaller ones. More emergency interventions, but quiet ones. More accounting games. More extend and pretend. The economy limps along, credit tightens, growth slows, but we avoid the apocalypse. The problem with this scenario is that it's painful. It means years of below-trend growth, years of tight credit conditions, years of uncertainty. It's death by 1,000 cuts instead of one dramatic blow. Scenario 3, the crisis. This is the scenario everyone fears but nobody wants to talk about. Something breaks. Maybe it's a major regional bank. Maybe it's a cluster of commercial real estate loans. Maybe it's something in the shadow banking system. But whatever it is, it triggers a cascade. Confidence evaporates. Depositors panic. Banks stop lending to each other. Credit markets freeze. And suddenly we're looking at 2008 all over again, or worse. Could this happen? Absolutely. The conditions are there. The stress is there. All it takes is the right trigger at the right time. What this means for your money. Now, let's talk about what this means for you personally. Because understanding the problem is only useful if you know what to do about it. First, and I cannot stress this enough, make sure your deposits are safe. The FDIC insures deposits up to $250,000 per depositor per bank. If you have more than that in a single bank, spread it around. This is not paranoia. This is prudence. This is exactly what sophisticated depositors do. And yes, this includes business accounts, where balances can be much larger. Second, if you're banking with a regional or community bank, understand their exposure. Not all banks are equally risky. banks with heavy commercial real estate exposure, banks with lots of unrealized losses, banks that have seen significant deposit outflows. These are the ones at higher risk. You can often find this information in their quarterly filings or through banking analysis sites. Third, think about your debt. If you have variable rate debt, credit cards, adjustable rate mortgages, home equity lines, understand that rates could stay higher for longer than expected. If you can lock in fixed rates now, that might be wise. If you can pay down high interest debt, even better. Fourth, and this is crucial, understand that a banking crisis affects everyone, even if your specific bank is fine. Because when banks get stressed, they stop lending. And when they stop lending, businesses can't expand. People can't buy houses. The economy slows. Jobs are lost. This isn't just an abstract financial problem. This is a real economy problem. The hidden opportunities. But here's something most people don't realize. Financial stress also creates opportunities. Not in a callous way, but in a practical way. When credit tightens, asset prices fall, real estate becomes cheaper, stocks become cheaper, businesses become cheaper. If you have cash, if you have financial flexibility, these are the times when generational wealth is built. Warren Buffett has a famous saying, "Be fearful when others are greedy, and greedy when others are fearful." Right now, most people are complacent. They believe the official narrative. They're not preparing, which means when the stress becomes undeniable, when the fear hits, there will be opportunities for those who saw it coming. I'm not saying to root for a crisis. I'm saying to prepare for one, to position yourself so that if and when stress intensifies, you're not scrambling in panic. You're making rational, calculated decisions. What policymakers should be doing now. Let me be clear about something. This situation is not inevitable. There are things policymakers could do to reduce the stress in the system. They could be more transparent about the actual health of banks. They could force banks to recognize losses sooner rather than later. They could provide more support for commercial real estate restructuring. They could create better safety nets for depositors. They could regulate the shadow banking system more effectively. Will they do these things? History suggests probably not until it's too late. Because taking preventive action requires admitting there's a problem. And admitting there's a problem risks creating the very panic they're trying to avoid. This is the paradox of financial regulation. The best time to act is early, when the risks are still manageable. But that's also when the pressure to act is lowest. Because everything still seems fine on the surface. So we wait, we hope, we cross our fingers and trust that somehow, some way, we'll muddle through. The truth beneath the surface. So let me bring this all together. The U.S. financial system is under more stress than they admit. The numbers don't lie. Over $500 billion in unrealized losses, trillions in deposit flight, rising delinquencies in commercial real estate, tightening credit conditions, emergency lending facilities, falling bank stocks. All of this is happening right now, in real time, while authorities insist everything is fine. Why does this matter? Because banking crises don't just hurt banks. They hurt everyone. They destroy wealth. They cost jobs. They damage the real economy for years. And here's the thing that should really concern you. We've been here before. The warning signs before 2008 were obvious in hindsight. Over-leveraged institutions, opaque risks, regulators asleep at the wheel, accounting games, misaligned incentives. Sound familiar? The difference is, this time, we're not dealing with subprime mortgages. We're dealing with something simpler and potentially more dangerous. Basic interest rate risk combined with commercial real estate collapse, combined with a massive shift in how people and businesses use banks. What you should take away. If you remember nothing else from this video, remember these three things. 1. The official narrative about banking stability is incomplete at best and misleading at worst. Trust your own research. Look at the data. Follow the money. 2. Stress in the financial system affects everyone, even if you think it doesn't apply to you. When banks stop lending, when credit tightens, when confidence falls, the entire economy suffers. 3. Preparation is not the same as panic. Making sure your deposits are safe, understanding your bank's health, managing your debt, maintaining financial flexibility, these are just smart moves regardless of whether a crisis materializes. The bigger picture. And here's the bigger picture. We've built a financial system that's incredibly complex, deeply interconnected, and fundamentally dependent on confidence. When that confidence is justified, when banks are truly healthy, when risks are well managed, the system works beautifully. But when that confidence is based on wishful thinking, on accounting games, on hoping that problems will just go away, then we're building on sand. And eventually, the tide comes in. I'm not here to predict the exact timing of when stress turns into crisis. Nobody can do that. Markets can remain irrational longer than you can remain solvent, as the saying goes. But I am here to tell you that the stress is real. The risks are real. And the gap between what you're being told and what's actually happening is wider than it should be. So stay informed. Stay skeptical. Ask questions, demand transparency, and most importantly, take care of your own financial house first. Because in the end, that's all you can control. You can't control the Federal Reserve. You can't control the banks. You can't control the regulators, but you can control your own decisions, your own preparation, your own financial resilience. And if enough people do that, if enough people demand better from our financial institutions and our policymakers, maybe, just maybe, we can avoid the worst outcomes. The system feels calm on the surface, but underneath, the pressure is building. Now you know why. Thanks for watching. If this video opened your eyes to something you hadn't considered before, share it. Because the more people who understand what's really happening, the better prepared we all are for what comes next. Stay safe out there.